It really comes down to how many hours of storage you need. Like you're in Arizona and most of your power is coming from solar, and you essentially need to soak up all that solar in the day and take it through the night. We would be way more cost effective than a battery for that. Our first hour costs a lot more than a battery, but then every hour after is only about 10% of the cost.
Welcome to Sustainability Leaders. I'm Michael Torrance, Chief Sustainability Officer at BMO. On this show, we will talk with leading sustainability practitioners from the corporate, investor, academic, and NGO communities to explore how this rapidly evolving field of sustainability is impacting global investment, business practices, and our world.
The views expressed here are those of the participants and not those of Bank of Montreal, its affiliates, or subsidiaries.
Welcome, everybody. My name is Stephen Uwazota, and I am a director in BMO Sustainable Finance and Clean Energy Banking Group based out of Toronto. And we are excited to host our guest today. Our guest today is the CEO of Hydrostor, one of the world's leading companies on long duration energy storage. And it's a pleasure to have the CEO and co-founder, Curtis VanWalleghem, with us today. Welcome, Curtis.
Oh, welcome, Stephen. Really excited to be with you and chat today.
Absolutely. So my first question for you, Curtis, is how did this all come together? It looks like you have the plans to help the world solve the most critical problem of energy intermittency for renewables. How did Hydrostor come together?
Yeah, well, the genesis, I was working at Bruce Power, a nuclear generator just north of Toronto, and we actually had a different problem. At night, there was too much power on the grid. And so I started to look into storage quite deeply, saying, well, could we not store that power and then release it the next day when we had a lot more revenue opportunities? And I met a guy who had this compelling idea of using this advanced compressed air. And so as I explored it more with him, I decided to leave my job there and start Hydrostor. It was only really a couple years later that the intermittent renewables really started coming on the system en masse, really driving the opportunity for storage. So it was a bit of a canary in the coal mine in Ontario, just because we have so much base load that it was, bringing the need for storage just kind of for a bit of a different reason. That's kind of what got me on it. 15 years ago now. I can't believe it's been that long.
15 years. That sounds like an eternity in climate net zero world. So good on you for seeing the trend well before this became more mainstream. You talked about energy storage. For regular folks out there, can you walk us through what energy storage looks like? Why is it important? And what types of technology alternatives are there out there in the energy storage world in general?
Yeah, so storage is just like you would think of storing electricity. You don't store it as electrons necessarily. You store it as chemical through lithium-ion batteries or flow batteries. There's also mechanical pumped hydro, where you pump water up a hill. You can lift weights. You can spin flywheel devices. There's a whole bunch. There's thermal storage, where you store it in heat and cooling and then use that temperature differential to turn it back into electricity. But if you think about our food storage system, we put food on shelves and in your cupboards, and oil, they got strategic oil reserves. Electricity is the one market where the amount of electricity produced and used has to perfectly match at all hours of the day. And so historically, you didn't really need storage because you would just burn coal or burn natural gas whenever you need it. And so the storage was actually in the fuel. But now that we're moving to wind and solar, the wind comes when it wants, the sun comes when it wants, in all different quantities. And so that brings the rise for electricity storage. So when you have too much sun and wind, store it. And in our case, we compress it and we store compressed air. And then when there's a shortage of electricity, you turn that back into electrons and sell it back onto the grid. So that's the general premise, and why it's needed now is because we're relying on intermittent wind and solar resources more. Therefore, you need something with that added flexibility to be able to store surpluses and give it back at times of shortages.
That's great and very helpful, Kurt. So you talked about the amount of electricity produced has to match perfectly with the amount of electricity needed. Are there different ways to achieve that?
Yeah. So there's a few different ways the grid operator manages that balance. One is through demand response. You could just tell customers to turn their factories off and turn their lights down. There's only so much of that people are willing to do. If they're got a productive business, they want to make it. So they'll maybe turn down a little bit, but it's on the margins. And then on the supply side, you could just waste and curtail surplus wind and solar. And then when there's a shortage, burn natural gas or coal. And that works for a certain extent. But then you start wasting so much wind and solar that it prevents more wind and solar from being built. Whereas when you bring storage to the equation, you get paid to take that extra wind and solar, and then you give it back cheaper than the gas plant would. And you enable more wind and solar to come on, which enables you to get paid more to take even more of the surplus, and then you give it back. So it just makes a lot more sense. In addition, it's 100% carbon free. So unlike the coal and gas, it has emissions with it. So this solution allows you to get to 100% renewable electrons on the grid at a lower cost.
So I'm hearing quicker pathway to net zero, less emissions intensive. Kurt, I have a 4-year-old who is interested in science. How would you explain compressed air solution in battery storage to him?
So the way our advanced compressed air energy storage solution works is we sink a shaft. So these are, call it 12-foot diameter. We go down 600 meters underground. We then hollow out the rock. Think of a football field, maybe 20 feet high. That's how much rock we pull out. We bring up that shaft. We then flood it with water. We then buy equipment that grabs the atmospheric air, compresses it, and sends it down into that cavern. And as you're filling the cavern with air, it's lifting the water out up to the surface. And then a valve holds it in. And when the grid needs power, you open the valve, gravity pulls the water down, pushes the air up, it spins a turbine, creating electricity, and then the air goes back to the atmosphere. So we just use the water for weight. As we push the air down, that pressurized air lifts the water up. And that's how it works. So it's just air, rock, and water offering a pretty compelling storage solution.
Let's talk about the economics of storage a little bit. Some of the things you've just mentioned sound to me like we should be developing storage en masse. Help us understand what the roadblock to adopting more storage. What does that look like? Because all that you've mentioned just sounds like this is a win-win-win. We get to deploy more renewable energy faster. We get to do it in a way that is less GHG intensive. Why would anyone not be signing up for this?
Yeah, exactly. Well, it is said that the electricity system is the most complicated system in the world. It is absolutely gigantic. It has so many moving parts, and again, it has to be in perfect balance at all times. So what's prevented it is it's taken this long for wind and solar to be a meaningful enough portion of the grid that you really need it. When it's just 1%, 2%, it just gets caught up in the noise. When it's 40%, 50%, now it becomes, a real heavy duty part of the grid needing the storage. So that was one. We just didn't have enough wind and solar on the grid. Number two, the markets had to change. The electricity system markets, how you pay for stuff had to change. Before it was, we'd pay you for your fuel. Well, storage doesn't really use a fuel, and a gas plant can run forever. A storage, a 1-hour battery is not the same as a 4-hour battery, is not the same as a 20-hour compressed air system. They didn't know how to price that stuff, how to dispatch it, and how to buy it. So that takes a while. And those markets are still not done everywhere. There's still quite a few markets around the world that haven't changed their policies to allow that. And then third, there was barriers. You would often get charged transmission charges twice, as an example, really hurting the economics. And then lastly, storage was not cheap enough. Gas plants were a lot cheaper, But with the drop in lithium ion costs and new technologies like Hydrostor's compressed air, the cost points are so much lower that it now competes very favorably against new gas plants. So it's kind of a combination of the underlying demand from renewables, changing electricity markets, getting the cost of the technology right, and changing certain regulations. So it's been a long-term journey, but I would say as of now, probably half of the new additions to the grid are storage or some form of storage. So it's becoming a very, very big part of new grid capacity, which is desperately needed now in the age of AI and all the growing demand. We haven't seen growth in electricity demand in 30 years in North America. Now it's growing at 5% a year. That's a big sea change for such a large system.
Right. Speaking of AI and the growth in demand, you talked about lithium-ion batteries. Speak to us about your technology from a speed to deployment standpoint and ease of permitting standpoint, because we know some of these projects take a long time to build. How do we rapidly respond to this AI trend and other drivers of increased electricity demand across North America?
Yeah, it's a great point. The permitting challenges are pretty straightforward for Hydrostor's compressed air system. We use just air, rock, and water. It's a very contained and small footprint, but it is new, so it still probably takes about a year or a year and a half to get a permit. The harder part is actually getting the grid connection. All projects need that grid connection. That can be 3-4 years in a lot of markets. Lithium ion has some challenges with permitting because of the fires and the toxic smoke that would come from the fires. So they're scrutinized pretty heavily as well from a permitting perspective. And then when it comes to speed to deployment, that is a big advantage of batteries. They can be deployed in 6 months, whereas our system takes about 3 years to build. So a pretty big delta. But the big advantage is we're a lot lower cost and we last 100 years, whereas every 10 years, you've got to replace all those batteries.
Right. And if I to follow up on that, I'm hearing not exactly apples to apples comparison, but it sounds like your cost of operating a compressed air battery solution like Hydrostor is developing, would it be fair to say that's significantly lesser than competing technology out there?
It really comes down to how many hours of storage you need. So if you just need, as an example, a battery for the top 2 to 4 hours in a day. So they're just going to, whenever the prices are the highest, they'll dispatch, then they'll charge up again and wait for the next day's high peak prices. A battery was much better for that. But if you're in a place that needs, say, 15 hours of storage, like you're in Arizona and most of your power is coming from solar, and you essentially need to soak up all that solar in the day and take it through the night, we would be way more cost effective than a battery for that. Because our first hour costs a lot more than a battery, but then every hour after is only about 10% of the cost. So at some point, you see where those two cross over because every hour for a battery costs the same. So they're better for shorter durations. We're better for longer durations. That's kind of where the split really comes. And right now, it's about 6 hours is kind of the dividing line. Anything longer than 6 or 8 hours, compressed air and pumped hydro tend to be better. Anything shorter, lithium ion is really the dominant technology.
Got it. Okay, that's super helpful. I'm hearing renewable penetration is a key driver of the economics and the cost competitiveness. You touched on it some moments ago, but I'm just putting on my credit risk hat, banking hat on now. High storage is you're paying for reliability pretty much. Walk us through that evolution for utilities where they just saw storage as reliability and they didn't necessarily have an incentive to pay the right economics for it versus where the industry is now, where, whether it's AI growth, whether it's, mission critical infrastructure that cannot afford to have brownouts or rolling blackouts. What's that demand landscape looking like from the economic standpoint?
Yeah, so the grid operators will run their integrated resource plans or their long-term plans to try to find what's the right mix of resources that can keep the lights on and deliver the lowest cost electricity with the reliability. And what they increasingly find is wind and solar are by far the cheapest way to get electrons. But you can't access that if you don't have the storage because you'll then start curtailing and wasting so much at certain times. So if you want those clean, low cost renewable electrons, you have to bring some storage with it to enable it. And those have to move in lockstep. You can't, only do the renewables, I'll do storage later. You've got to keep buying them together. So that's where we're seeing is instead of just building new gas plants, the utilities are saying it's better to go for wind and solar. But to do that, you need different storage. You need some short duration, some long duration. But that basket, when you combine it with the renewables, is the cheapest and best way to keep the lights on. So now that load growth is growing, all the utilities are trying to buy stuff as fast as they can, as much as they can, as low cost as they can. And the tech companies, most of them, prefer a carbon-free source if they can get it. But if they can't get it, they still got to grow their business. So they're gonna take whatever they can get.
Right. Let's talk about supply chains and how they play a role in the deployment of your technology. You talked about air, rock, and water. And the amateur geologist in me suggests that those are abundant resources, obviously not unlimited, and especially when it comes to water, versus some other technologies where you're a bit exposed to trade headwinds, geopolitical headwinds. How insulated are your inputs from geopolitical risk, from trade risk? And how does that, if you have any advantages, how does that support reshoring, onshoring, or reduce risk of execution?
Yeah, that's a great point and very timely given everything happening in the world. Lithium ion, I think most people know, is dominated by the Chinese. And even when you're making stuff, a lot of the anode and cathode materials still come from China. So in the United States, as an example, with their tax credits, and they're saying you can't have any Chinese components, or if you buy anything, you're going to get these massive tariffs. So it's a big problem for lithium ion. That's one of our strengths relatively. Roughly 85% of our cost to build is from the local market, wherever that is. In Australia, in Canada, in the US, we hire local, we buy some steel, a little bit of concrete, a tiny amount of water, only about 5% compared to a pumped hydro plant. And we actually produce water when we run. So it's actually very water conscious. We just use the atmospheric air and we dig a hole in rock. And that rock, we can go to about a third of landmass has suitable rock for us. So we hire local, we buy local, and we build local in the market. So we're very resilient from that supply chain. So it's been a very busy 15 years of inventing the technology, protecting it, demonstrating it at scale, building a global team to then go out and deploy it. And then once you get ahead, it's really hard for people to catch up, especially since you need a lot of money. We've raised, over $500 million at Hydrostor. It's tough to, get that amount of capital, especially when you're playing catch up to someone that's already out ahead of you. So yeah, it's really a combination of all those things.
Excellent. Well, $500 million in equity. That is, I would say congratulations to you and your team for that milestone and acknowledging the capital constrained environment. That is even more impressive. Kurt, I want us to touch on some policy conversations from a tailwinds and a headwind standpoint. It seems storage is recognized as a part and parcel of the energy security, North American energy independence conversation. Maybe talk us through some tailwinds you're seeing.
Yeah, certainly. Always better to be positive as an entrepreneur. The low cost wind and solar is kind of like the underpinning tailwind. Those costs continue to come down, especially for solar, and the more intermittent, the more storage you need. So that's the first one. It's fundamental, and I can't see it changing. Then the governments have come in with these investment tax credits. They are looking to pull some of them back, but they've identified storage as part of these resources that need to continue to get the tax credits. So we're helpful and glad to see those continuing, albeit that they do look like they're going to end them for wind and solar, but they kind of serve their purpose. They got wind and solar to scale up, got the cost down. In terms of the headwinds, grid capacity is probably the biggest one. Where do you plug into the grid? It's almost full, and it's really hard to build new transmission lines. So finding capacity to plug in. And then the other tailwind would probably be, well, two more. One is around the permitting. It's just harder to build anything. Everyone's not in my backyard. It's great to see in Canada, they're starting to look at permitting reform to speed things up. In Australia, they're doing something similar. Well, if you build in certain zones, you get accelerated permits and the like. And then there's the access to capital. There was a bit of a balloon forming, if you would, maybe 4 or 5 years ago with the SPAC market and all the money rushing in after the Paris Climate Agreement. I think that maybe got a little ahead of itself, but it's really pulled back now. And it's really hard. If you're not a cash flowing entity, it's tough to raise money, especially for climate, energy transition, capital intensive sectors, as you know well, being in the advisory business. So just being very disciplined with your capital, strategic about how you raise capital and build your business plan, and just managing that very tightly.
You talked about the 3-year build. You talked about signing contracts with utilities. What's the time scale? Like, you've done all this good work. How are you keeping your equity stakeholders, your capital providers? How do you keep them patient while the build out is going? And is there a pathway to them beginning to see some of the upside of these multi-billion-dollar, multi-year projects?
Yeah, a very important point, and one my board is no doubt happy you asked. So our main investor, Goldman Sachs Asset Management, their private equity arm, as well as the Canadian Pension Plan and the Canada Growth Fund. Those are kind of our 3 biggest investors. Then we had a bunch of earlier venture investors. I would say for the earlier stage venture investors, it was more of a bet on the market and the team. Do they think storage will be required? And do they think me and my team could get it done? And the technology that we had. They believed in it. How you were going to get profitable, they maybe weren't too sure, but they had some theses. And to be fair, they've done quite well. They've probably, call it, got a 5 to 10x on their investment based on our current share price. When Goldman Sachs and these more institutions come in, they came in early, seeing the big opportunity, but knowing that valley of death. And they said, this is a big enough opportunity that we're willing to provide a lot of capital to get it through this valley of death, which is, commercializing new hard tech. Often requires a bunch of upfront money, a big wait before the money starts coming back. And the way it works is we sign, call it $3 to $4 billion of revenue contracts. And then we got to build a plant that costs $1.5 billion. You get 75% debt. So you're putting in $350 million, and then you get, call it, a 15% return on your capital every year for 50 years. So that's a pretty good business model. What we do is we do the development, and then we construct it, and then we sell it down. So instead of giving a pension fund 15%, we'll give them 11 or 12. And then we keep the delta for ourselves, which makes our return look more like 50%. So for every dollar they give us, we can turn it into a 50% return. And you're talking hundreds of millions over a long period of time. That's what gets them very excited. So we're a place to put money once you've already locked up the revenue contracts for a long period of time. So there's no real revenue risk. Once you've got the technology proven, there's no cost risk, and then there's no competition because we're the only ones that have the technology. And so then we go out and we got to compete with batteries and stuff. But like I say, they play in a different part of the market. So it's a big bet, a big opportunity. But I think I said earlier, we have 15 projects that we're moving forward on right now. Each of those is $1.5 billion. So you start to see quite a bit. And then each one we're signing 4 billion of revenue contracts. So you get some pretty big numbers. The next phase for us will be licensing, because then how do we go to India, to Japan, to Eastern Europe, Western Europe? I can't see us standing up a team and mobilizing this much capital everywhere. So I think what we do then is you license it to a utility, a construction company, a developer, and then they build in their local market. They get the capital, and then we just get a royalty off of that.
That definitely sounds like the type of revenue model that will get any capital provider excited. Once you sort of get that build cost out of the way, you almost start kind of clipping a coupon in perpetuity, for lack of a better word. You touched on a few points that I just want to revisit. You talked about the value of death, and this is us doing the early version of one of your book tours as a CEO who sort of survived that value of death experience, raised capital in a very difficult environment, scaled a business, and scaling a business in a very challenging geopolitical environment. What advice do you have for any CEO looking to raise capital? Maybe not necessarily in this market, or just scaling through this value of that experience as an entrepreneur?
Oh, you could probably write a book on just that. The simplest advice that I would offer is raising capital is really a trust. It's about you and the people that are betting on you. And you've got to build that trust. You've got to get to know them. You've got to explain your values, why you're doing the business, because they need to know when the business gets tough, you're not just going to fold up and go on, that you're going to push through, fight through, get creative, that you care as much as they do, because their jobs are on the line to a large extent, even though they're investors investing in a bunch of different things. They're going to a committee betting on you, and their reputation and career kind of matter. So they want to know that they can trust you. You're always going to be truthful. The second one is make sure you get the right type of investor. I found early entrepreneurs just chase every phone call that comes in and just anyone that'll talk to them. And you got to do some of that to learn and to build your network. But there's really certain types of capital providers that are the right fit for the right type of business. And you sometimes get, I know one of the rounds we did, I think I got rejected over 200 times before I found that right investor. And it's hard on your ego, but as long as you're learning and you're narrowing and you're adjusting your focus based on that feedback, and you've got the resiliency to keep going, I just kind of leave it there with those two just very basic elements.
That's great. I have two more questions for you, Kurt, before we wrap this up. One question is, what is one benefit of your technology, your solution, that you and your team feel the market hasn't fully priced that benefit into the way they approach the economics? And maybe the final question, I'll leave it to you to roll both of them together, is if you had a magic wand and there was something you could fix with that wave of the wand, or if you prefer genies, if you want the genie to come out of the bottle and solve that one particular thing, what would that be?
I'd say on your first question, the one thing that the grids don't really pay for yet is inertia. And so you heard of that big blackout that happened in Spain and Portugal recently. If you don't have a right inertia on the grid, it can lead to a collapse like that. Wind, solar, and batteries don't provide that inertia. It comes from a spinning mass. Nuclear, coal, gas plants, hydro, and our type of compressed air provide that. But because there was always so much of that stuff on the grid, they just always had a surplus of inertia. Now they're starting to realize they don't have enough in pockets. And in Australia, they're now starting to pay for it. I think that's going to spread as there's more DC connected devices. They're going to realize, oh, we need more inertia. And then rather than buying a battery system and then putting a synchronous condenser beside it, we give you both for one. So that's one, inertia. Everyone knows it's coming. It's just when, and every grid's a little different. In terms of the magic wand, I think I'd go back to something you said in the higher for longer environment from an interest rate. If you consider renewable electrons, wind, solar, storage, we have to put all of our capital up front. And then you've got a 20-year, 50-year, in our case, 100-year payback period. Compare that with a gas plant that they put a little bit of their capital up front, but then they pay for fuel every day they run. But they have much less upfront exposure that they have to finance with debt. So the higher interest rates are, the more it favors coal and natural gas, and it disincents storage and renewables because you have to finance more of it up front. So I would love to see interest rates come back down. It's marvelous to see how low they were for so long, just when we weren't constructing big, heavy assets. And now that we're in the construction phase, the interest rates shoot up. But it is a really big deal, and it really moves the pricing needle on these technologies that have to finance everything up front. So I'd love just interest rates to magically go down for everyone's mortgage and everything. But maybe a secondary is a government program that for financing critical infrastructure, do we give them a lower break or some sort of governmental guarantee that helps bring down the cost of that financing?
I couldn't agree more with you. The point you raised around inertia is really, really important. And I'm rooting for the industry to get there faster. And yes, I would love my mortgage to come down. In this environment, it's tough on everyone, but we continue to be optimistic that the future will look brighter. And with that, from all of us at BMO, Kurt, thank you very much and good luck to Hydrostor.
Thank you so much, Stephen. It's been really a pleasure speaking with you today. Wishing you all the best.
Thanks for listening to Sustainability Leaders. This podcast is presented by BMO. You can find our show on Apple Podcasts, Spotify, or your favorite podcast player. Press the follow button if you want to get notified when new episodes are published. We value your input, so please leave a rating, review, and any feedback that you might have, or visit us at bmo.com/sustainability leaders. Our show and resources are produced with support from BMO's marketing team and Puddle Creative. Until next time, thanks for listening and have a great week.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.